Welcome back to the channel, everyone. Today I want to talk about a former SEC chief exposing Citadel, and how Vlad and Kenny may have actually spoken before, thereby exposing another of Citadel's lies. So stay tuned and let's make some money. But before I dive into the video, if you haven't already, be sure to sign up to Moomoo using the special Thomas James investing promotion. Not only do you get a free stock worth up to $350, and not only do you get a second free stock with a guaranteed value of $50 on top of that, but you also get a third free stock with another guaranteed value of $30. So that's at least $80 in guaranteed free stocks, just for signing up to Moomoo and depositing at least $100. You could always sell those stocks and get 2 entirely free shares of AMC, linked in the description below. And now I want to dive straight in with the key information. So, a former SEC branch chief just tweeted saying, "What is Citadel doing with all those tweets? They seem to be listening to their PR people rather than their lawyers." Their position seems to be that they could not have been engaged in antitrust violations because the DTCC issued a margin call that Robinhood could not meet. But Citadel could have been colluding with Robinhood to prevent additional purchases of meme stocks and save Citadel big money at the same time the DTCC was issuing a margin call. Because most importantly, these are not mutually exclusive events. Just because the DTCC issued a margin call doesn't mean that Citadel didn't ask Robinhood to prevent the purchase of meme stocks. We don't know if Citadel was talking to the DTCC as well. There's a lot that needs to be investigated. It does appear Ken Griffin was not wholly truthful with Congress. Not to use legal jargon, but this is a no-no. Citadel's calls and messages with Robinhood could have caused Robinhood to decide to restrict meme stock trading, rather than just take other actions in response to the DTCC margin call. And that is what government and class action lawyers will be investigating. Maybe the DTCC and Robinhood could have settled on something that didn't involve the restricting of meme stocks. Maybe they could have settled on using a T+0 timeframe instead of T+2, meaning that Robinhood buys the stocks for their customers on the same day rather than 2 days later, because that would have obviously minimised some risk. Robinhood would have been buying the stocks there and then, and therefore not suffering any slippage, rather than purchasing 2 days later, where GameStop wouldn't have been trading at $400 a share, it would have been trading at $4,000 a share. But because Robinhood would have purchased on a T+0 basis, they wouldn't have been suffering any financial loss, and therefore wouldn't have needed to pony up that collateral with the DTCC. Or maybe they could have decided on some other alternative deal. Maybe Robinhood put up half of that collateral, and somebody like TD Ameritrade put up the other half of that collateral, and they split the profits between themselves from the customers. There's probably 1,001 other ways that Robinhood could have got out of that $3 billion margin call without having to restrict the trading of meme stocks. And therefore, as the former SEC branch chief suggests, maybe the calls between Citadel and Robinhood, or the messages between Citadel and Robinhood, is what really caused Robinhood to restrict meme stock trading. At least somebody in the SEC, or somebody that used to work for the SEC, agrees with retail and thinks there might have been some other shady ulterior motives between Citadel and Robinhood. Now there's a tweet here from George to Vlad saying, "Hey Vlad, why haven't we heard from you? The walls are closing in, I know you feel it. Don't let your boy pin the GameStop scandal on you. You know he will. Come out and speak, tell the truth. Be the good guy." This is kind of what I was getting at in my video the other day. Citadel have obviously been posting tweet after tweet after tweet, accusing Robinhood and throwing them under the bus. But throughout this entire ordeal, we haven't yet heard from either Robinhood or from Vlad himself. It'd be really interesting to see if Vlad comes out and holds his hands up and says, "Yep, it was me, I solely restricted meme stock trading, Citadel weren't involved at all," or whether Citadel did in fact pressure him. Now Ragnar Eriksson on Twitter posted yet another screenshot from that court case that's been going around recently, an extract from an email chain between Robinhood and Citadel, saying, "Hi Jim and blank. The head of our business blank, whom Vlad has met before, is available until 10 PM EST to speak to Vlad. Let me know and we'll set this up." Now I assume this is "Hi Jim and Vlad" at the start, but then it says "the head of our business blank." Maybe that's Ken Griffin, because obviously Ken Griffin is the owner of Citadel. But while Ken Griffin is the CEO of Citadel LLC, I don't think he's the CEO of Citadel Securities, or maybe I've got that back to front. so it could be somebody else. Or alternatively, the head of our business could be somebody like the chief operating officer, for example. But anyway, let's continue. Jim replies saying, because of our partnership, Vlad would like to have a discussion with Ken at some point, just given our relationship. Not specific to this crazy issue. And then the person from Citadel says, makes sense, we can look to set that up at a later date. Let me know if you guys and or Vlad want to hop on a call with blank tonight. So I assume it's referring to somebody else and not Ken in that instance. And so these emails were sent at 8:38, 8:32 and 8:29 PM. But then Jim replied a lot later at 1:41 in the morning saying, nope, just got off the phone with him. Just looking for your dictated schedule and caps. I have 20 minutes until batch, so whatever it is, we're not going to be able to address it tomorrow, given the notice. I have to say I am beyond disappointed in how this went down. It's difficult to have a partnership when these kind of things go down this way. Jim. Now for starters, that is a very, very late night for Jim, being in the office until 1:41 in the morning. And then it's quite interesting how he says just looking at your dictated schedule and caps. And also says he's beyond disappointed in how this went down. Maybe that is to do with Citadel pressurising Robinhood. It'll be really, really interesting to see what comes out of this court case and this lawsuit about exactly what went down with this conversation. Now you may remember the Panama Papers and the Paradise Papers, and now we've got the Pandora Papers. So ICIJ have just tweeted saying soon everyone will be talking about the Pandora Papers, the new investigation, our most expansive expose of financial secrecy yet, drops Sunday at 12:30 PM EDT or 4:30 PM GMT. Get ready for reporting from 600 plus journalists from 150 media outlets in 117 countries. Now it'll be super interesting to see what's released about Citadel and Robinhood and many other sketchy financial institutions out there, and whether any of it can relate to AMC and GameStop. Or whether it's just about them hiding money offshore in sketchy methods, just like usual. Now also Boss Blunts on Twitter and on YouTube has done some additional digging on just how much unrealized derivative losses are out there right now. Banks owe $426 trillion in notional unrealized derivative losses. Global economic meltdown inevitable. Previously, I made many Reddit posts and YouTube videos showing banks having $189 trillion in derivatives notional unrealized losses. The thing is, I forgot to add in how much the holding companies have as well. So this here is the notional unrealized losses of derivative contracts for the top 25 commercial banks. As we can see, JP Morgan is number one with $53 trillion in derivatives. We've also got Goldman Sachs with 47 trillion, Citi with 43, Bank of America with 18, so on and so forth, which all totals to $182 trillion. But it's also worth noting that the overarching holding companies for these top 25 financial institutions also hold derivatives of their own. We've got JP Morgan's holding company with not 53 trillion, but a separate 52 trillion on top of that. We've also got Citigroup's holding company with not 47 trillion, but a separate 43 trillion on top of that. A little bit lower down, we've got the Bank of America holding company, not with 18 trillion, but with a whopping 35 trillion separately. And in total, we have a separate 244 trillion in unrealized derivative losses. And that's against assets of only $18 trillion for the holding companies and 14 trillion for the institutions themselves. And therefore the total notional derivative unrealized losses for America's top 25 banks and their holding companies, of which they main fiduciary control, is 426 trillion US dollars. And that is why Janet Yellen said that over-leveraged hedge funds and financial institutions will cause financial runs. And now finally, we've also got Goldman Sachs flagging an $8.2 trillion threat worse than China's Evergrande. So the real worry concerning China's Evergrande default drama is the inevitable where there's smoke, there's fire paranoia that accompanies debt stumbles. The most worrisome such blaze, say analysts at Goldman Sachs, is surging local government debt levels that President Xi Jinping's men have done their best to hide. The default troubles at the globe's most indebted property development seems like small embers compared to the $8.2 trillion worth of local government financing vehicles outstanding. And that's just the local government financing vehicles we know of. The data that a Goldman Sachs employee highlights is at the end of 2020. Clearly the tally is higher now, perhaps markedly. 10 months ago, the shadowy investment schemes had reached 53 trillion yuan, up from 16 trillion yuan or $2.47 trillion in 2013. In other words, as scary as the $300 billion Evergrande story might be, Xi's government has got much bigger problems on its hands. These days, international investment banks and news organisations worry that warning about China's local government debt bubble will open them up to retaliation, and therefore it's no wonder that some of the globe's biggest investors are taking a pass on yuan-denominated assets. For every Ray Dalio singing China's praises, there's a George Soros warning of the tragic mistake being made by those rushing into mainland markets. Count Japan's $1.7 trillion government pension investment fund, the world's largest, among the latter. It now says it won't even include yuan-denominated Chinese sovereign debt in its portfolio. The timing is bad for China. The FTSE Russell Index is just about to begin adding Chinese debt to its benchmark global bond index. In July, GPIF president said the investment whale needed to be cautious about investing in Chinese debt. And now Xi's China is getting an answer. The bigger question, of course, is how the Evergrande chaos collides with excessive local government debt at the same time that Xi pulls the rug out from under China's tech sector. If you smell smoke emanating from the Greater China region, you've got some very rich company. Guys, be sure to let me know down in the comments below what you think about a former SEC branch manager exposing Citadel. And also, let me know whether you think that Citadel did really pressure Robinhood to restrict trading on meme stocks. And while you're down there, be sure to sign up to Moomoo using the special Thomas James investing promotion, linked in the description below. And as always guys, if you enjoyed this video, be sure to check out some of my others. Alternatively, subscribe to the channel and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.